Good evening and welcome to this webinar session. This evening, we dive into the question, should investors fear a recession? And we're going to peel that onion a few layers deeper, right? So I don't think it comes as a surprise that investors have suffered one of the worst starts to a year since 1970. And that's what 50 years of market history. There's a lot going on. There's a lot that went through that those 50 years. And this year we saw double-digit declines in global equities and bonds. I think that in particular has gotten people worried, right? Both asset classes dipping in the same year to such degrees. Now, with continued aggressive tightening by central banks to tame the so often talked about high inflation levels, a recession, or even just the thought or the idea of a recession has negatively impacted markets and investment portfolios. So as bearish as sentiment has gotten, should we really be this concerned about a recession and its market or financial impact? What makes this time different from the 2020 pandemic market crash, where we saw a V-shaped recovery in financial marketplaces? And looking ahead, what key factors and data points should we be watching that could alter the market's perception of recession risk? Now, we're going to get into all that in just a little bit. But before that, let's run through some housekeeping as well as a quick introduction to Mytheo for all the new folks in the audience today. We've actually got quite a number of people who are new to the webinar, including myself. But yes, so first things first, let's go through the obligatory disclaimer. All right, ladies and gentlemen, please take note of the disclaimer. I'm going to leave it on screen for about 10 seconds here. I'm not going to go through the entire thing because that would just be boring for everyone to just listen to that. But a few things to take note, of course, right? Things like there's no solicitation here that's happening. Speak to your financial planners, your financial advisors before you undergo anything in the financial realm. And one of my favorites, of course, is that past performance is not indicative of future result. Along those things, right? Again, the history can rhyme and inform us, but not necessarily a predictor of future performance. On top of that, we are taking questions, everyone, and people have so quickly went to the Q&A to tell me that I was coming out loud and clear when I had so silly left the chat box off, right? So again, everyone's the Q&A box should be on the bottom of your panel. If you've got questions there throughout the session, please put them in the Q&A box. If the question is related to what we're talking about, I will bring it up. If it is not related, we will keep it to the last 15 to 20 minutes, or once we're done with, well, my questions, right? I haven't done Ring In since a long time. I'm looking forward to interviewing someone. It's been a while. Okay, so first things first, or actually this is third things third. Mytheo is the product and GAXMD is the company. And essentially GAXMD is a partnership between Silver Lake Group Malaysia and Japanese firm Money Design, who Money Design is behind the Mytheo robo-advisor in Japan. It was the first robo-advisor in Japan, and together they came together and formed GAXMD and the product known as Mytheo, which is a robo-advisor. The GAXMD got the license from the Securities Commission in 2019 to provide a digital investment management service, and they've been doing it for the last few years. As of July 2022, the group's assets under management as a whole is about $1.7 billion US from around 130,000 investors. Now, Mytheo, robo-advisors have become entered. It's been about 3-4 years now, and they have attacked a certain segment, right? People still have choices in the marketplace, but where the robo-advisor is coming in is essentially trying to provide you a one-stop accessible solution to get global diversification in one place, right? Using ETFs to build a cost-efficient portfolio without having multiple layers of costs and fees involved here, and also having all those fees transparent for you out in the open, all on your phone and trouble-free maintenance, right? Essentially, we take on that the burden of maintaining everything, and all for that fee of 0.8 to 1%, depending on the platform. One thing though, in my few weeks here at Mytheo, is I've noticed that Mytheo's particular offering is highly personalized based on their degree of essentially the number of ETFs, but also the way they analyze the portfolio and build one out for you. But I'm not going to dive too much into that. We can leave that sales page for another day. So without further ado, let's bring on the main guest today, the main event, to help break down and make sense of recessions and their market impacts, as well as points to watch out for looking ahead. Mytheo, Stuart-Box, Chief Investment Officer of Mytheo. Mytheo, how are you doing?
I'm fine, thanks, Roshan. Hi.
How's the weather over there in Tokyo?
It's okay. It's okay. It's a little bit hot and sticky, but it's okay. Yeah.
Yeah, it's been very rainy over here. I don't know about everyone else in the audience, but I've had trouble getting home the last few days. It just seems that a 30-minute journey is becoming a 45-minute journey or 60-minute journey, just with a little drizzle, right? Malaysians seem to forget how to drive once the rain comes in. But aside that, the banter about the weather, it's classic banter. But when we take All right. Hi, Mytheo. Can you hear me?
Yep. Yes.
All right, cool. So, all right. You've been at not Mytheo, but you've been at Theo, Japan for about 3-4 years right now. If I got that right?
That's right. Yeah, 4 years. Yes.
All right. And before that, you spent, I think, 15 years at BlackRock. Could you tell us what you were focusing on when you were there, just to kind of inform the audience here of what your background is?
Yeah, sure. So I spent actually a total of 18 years at BlackRock. And I was a portfolio manager at BlackRock for the whole time. My speciality was fundamental quantitative analysis. And so I was using quantitative models to evaluate Asian stocks based on their fundamental characteristics, their value, their profitability, their earnings growth, that kind of thing. And so I was managing mostly corporate pension, sovereign wealth fund money, also some retail money as well.
Fantastic. And when you say, when we hear terms like quantitative, I think a lot of people tend to go towards the technical analysis, right? It's when you say quantitative, it's about charts and momentum. But that's not what you did at BlackRock or what you do now as well.
That's right. It was very much based on fundamental analysis. And so it was very much looking at the value, the profitability, the quality of companies, but doing that in a quantitative model-based approach.
Right, and would it be fair to say that that has also translated over to the Theo and the Mytheo models as well?
Absolutely, yes. Yeah, a lot of the models that we use at Mytheo and Theo have a lot of similarities to the kind of models we were using at BlackRock. Yes.
Fantastic. So on that note, we're going to go into, I've got a list of questions here for you, Matt. But before that, I'm going to hand over the screen to you because I know you've got some slides as well in response to some of my questions. So I'll stop sharing over here. And once you put up your slides, I will start with my questions.
Okay. Yep.
Okay. All right. So first things first, I see this, you've got this beautiful chart in front of all of us right now, present value calculations. And this is an anticipation of my first question, right? Because when we talk about inflation, when we talk about recession, before we get into should we be worried and all these different things, a lot of us intrinsically understand that a recession is negative, right? It brings out fear, it brings out some kind of fear, essentially, right? A certain sense of anxiety. And I can tell you, technically speaking, what it means is that the economy is shrinking, right? Aggregate income is shrinking here. But how does that translate into financial markets? Could you break that down for us?
Yeah, sure. Thanks. Yeah. So I was a little nervous about starting with an equation, but I think, this is a very intuitive equation. And I think a lot of people will have seen a version of this. And this is really the kind of financial theory way of calculating the current value of an asset. And it looks a little complicated, but it's very simple. All we're doing is we're looking at the future cash flows, this part on the top here, CF, the future cash flows that we expect to receive from the asset. So these could be dividends that you expect to receive from a company, or interest payments from a bond, or the final maturity value of your investment. And they're discounted back to some kind of present value based on this discount rate R that's on the bottom of the calculation. And this takes into account the fact that, $100 in a year's time is not worth the same as $100 right now. And if we think about the impact of a recession on market prices, you can think about how it impacts these two elements of the calculation. In terms of the cash flows, so the top part of the calculation, obviously going into a recession, as you said, it means income is falling. And so you could expect perhaps lower cash flows in the future. If you're investing in a company, that might translate into lower earnings growth, lower dividends. If you're investing into bonds, it could translate into a higher chance of default on the bonds, and so these cash flows become a little less predictable. But also, if you're thinking about selling your asset in the future, perhaps under a recession you'll be able to get a lower price than without a recession, and so a recession is likely to lower this stream of future cash flows. But then it's also likely to raise the discount rate. Recession really means uncertainty. We don't know what's going on in the economy. And more uncertainty in general means that people will want to discount future flows by a larger amount, because to take into account that element of uncertainty. And so you can think of going into a recession impacts both sides of the valuation of assets. So it's perfectly natural, as you said, that the investors are worried about all this talk about recession in the US and in other countries as well.
Right, man. Let me try and break that down a little bit further, right? So, and then let me know if I'm on base or off base here completely. So when we take a look at present value calculations, we're looking at future income streams. So basically how much money or how much cash flows are being generated by a business, by a bond, or something or the other. And then when you say discount rate, usually we use something like interest rates, right? The base, the treasury yield, treasury interest rates, Fed fund rates, as a baseline for how we value future cash flows, because it's the bare minimum that you can get. So if interest rates go up as they are going now, that impacts valuations as well, which also could be in fact further impacted by recessionary risks, because recessionary risks, particularly now because of inflation, people are raising interest rates to combat that. And then with other recessionary risks, when incomes are coming down, which could also translate to cash flows coming down for businesses, which means then again, valuations could come down, which then comes back to why we see changing valuation assessments for financial markets. Roughly speaking, on base there?
Absolutely. Yeah, that's exactly right, yes.
Yeah. So this is how we calculate present value or valuations for most asset classes that are income producing, right? You can't use this for gold, you can't use this for crypto, more or less. So this is something we can apply to income producing assets. Now, let's get to the main title here, right? So we very clearly titled the webinar, Should Investors Fear a Recession? I don't want to make that the last question and put a lot of waffle in between. Let's get to that question straight away, because I actually have some other points that I want to get into as well. And if people want to stick around for that, it's going to be interesting. I can say that. So as the title of this webinar clearly asks, should investors fear a recession, Matt?
Okay, thank you. Well, first off, let's have a look at see what actually happens in a recession. I think we ought to start there. And so a natural place to look at is history, what's happened in the past. And so this is focused on the US. So this is looking at all of the US recessions since World War II. And so you can see down here various recessions through the 50s and 60s, all the way through to this one here, which was the start of the pandemic recession. And then these columns over here are showing the stock market performance. This is the performance of the S&P 500 during various periods around and during and after the recession. And it's showing how much the stock market moved during these periods. And there's a couple of things we can say. If we look first off at the average return down here, we can see that, well, we've got whatever it is, 9 recessions since the war. The average stock market return during the period of the recession was essentially flat. We got -1%. So it's not the case that the market tends to fall a lot during recessions. It's essentially flat. Then if we look at these two columns, which are the 6 months and the 12 months before the start of the recession, we can see also these are very small, on average, very small negative returns. So in the 12 months before the recession, on average, the S&P has returned -3%. And then as we go over to the right-hand side over here, we're looking at the periods after the end of the recession. So 6 months after, 12 months after, 2 years after. And we can see in this case, it's very clear, the stock market tends to do well in the period after the recession. And so if we look at the 2 years post-recession, after the end of the recession, the average return is 20% on the S&P.
So this is a fascinating chart, Matt. And a few things I've noticed here was, so if we look at the average returns, now obviously we're not looking at the distribution of those negative returns as well, right? But what we're seeing is a lot of it gets priced in before an actual recession hits. I mean, we're looking at single-digit numbers here. But also after the fact, we're seeing 7, 16, 20% returns over the longer term. Yes, it's coming from a lower base effect, but it also kind of shows that once you're in the storm, there's less to fear going ahead, or at least there's more to gain on the longer term. This is not specific advice to go and buy anything, ladies and gentlemen, just observation of some data and charts over here. Sorry, back to you, Matt.
Yeah, thank you. Yeah, that's exactly right. I think what this is showing is, on average, a recession is not necessarily a disaster for equity prices. You mentioned there's a distribution here. That's a good point to make. If you look at the individual cases in here, there's a lot of variation. And so you can see even during the recession period, even though the average is essentially flat, there are cases, for example, this one here, 2007. So this is obviously the Lehman shock, where the stock market falls substantially. It fell nearly 40% in this case. But there are other cases where the stock market actually rose during the recession. So the point is, there's a lot of variation. No two recessions are the same, and no two recessions have the same impact on the stock market. Maybe just to mention, where we stand right now in terms of the US market. Just to be clear, if we did have a recession in the first half of 2022, and we'll come to that shortly, well, during that period, the S&P fell 21%. So it fell by way more than the average of a recession. Having said that, in the period before the recession, obviously the S&P was very strong. So if you look at the 12 months leading up to the first half of this year, the S&P was up 27%. And so you can see that this recession looks, if there is a recession in the US, it looks quite different from, certainly from the average case in the US.
Right. Okay. Yeah. So I guess that's also what's not what's being alluded to, but one of those things is we'll get to this in a bit, but there's this discussion about whether the US is really in a recession or not, right? Or technically 2 quarters it is, but there we go. This is the slide. There we go.
Yeah, thank you. I think that we should talk about this. And so there's a lot of discussion about is the US in a recession or not? And so it's an important thing to note that you don't actually know at the start of a recession whether you're in a recession or not. That's kind of a strange thing to say. You know after the fact when the GDP numbers come out, but at the start of the recession, there's a lot of uncertainty about whether GDP is actually growing or not. There's a time lag between the actual event and the GDP numbers coming out. And so we found out that in the US, there was small negative growth in GDP, both in Q1 and Q2. Now, in the US, the recession is not simply defined based on GDP growth. They use a range of other measures as well. But this gives rise to this phrase, technical recession, which a lot of people have mentioned. And so GDP has been falling for the last 2 quarters. And so people are claiming that the US is in a technical recession. But it's also clear that this is a very different kind of recession from a lot of other ones in terms of, if you look at other measures of how the economy is doing, then actually things look very good in the US. Most people would look at kind of employment rates as one measure of recession. And as everybody knows, the US job market is still very, very robust. It's very strong. Unemployment has been coming down gradually. Right now it's at 3.5, and the US economy continues to create new jobs. Things like consumer spending, that's still rising. Inflation is still high, but there's signs that it's slowed. And so it's clear that even if we are in a technical recession in the US, it's a very unusual kind of recession. It certainly hasn't at this point spilled over into employment or consumer spending.
Yeah, it is definitely very fascinating to see the kind of debates on, I mean, just discussions that are happening around this. Is the Fed going to be able to manage the soft landing? And, you know, it's very polarizing, right? Whenever you talk about the Fed nowadays, did Powell do a good job? Did he do a bad job? Should they have acted as they did? Did the US Treasury put too much stimulus in the market? A lot of things, I think, are there to be talked about. But looking ahead, of course, there's going to be Jackson Hole this weekend, this Friday. So everyone's going to be, I'm sure, scrutinizing every word that comes out of Jerome Powell's mouth this weekend. On that note, though, Matt, let's take a look ahead as well. Wait, are we done with the recession slides, Matt? Or do we have one more? Yes, we have one more.
Yeah, maybe just to mention one other aspect of this. You know, as an investor, you really care about markets. And so maybe we ought to, I've used this slide in the past in other presentations, but I think it's worth revisiting, you know, what do bear markets look like? And this is a similar kind of chart showing all of the US bear markets since the war. And here we're defining a bear market essentially as a fall of more than 20%. There's a couple of cases that are just under 20%, but essentially 20% fall. And they're looking at, you know, how big is the fall and how long does the bear market last? And you can see there's actually a larger number of bear markets than there are recessions. And the average is about a 30% fall in the S&P. And in terms of the duration, this is in months. So on average, the bear market lasts just under a year.
I just wonder what that number would be if there wasn't the pandemic market crash, right? Because if you look at the duration, it's 1.1 months.
Yes.
So immediately that's probably brought down the average quite a bit as well.
That's a good point. Yes. Yeah. That's a good point. There was a very short bear market there.
Yeah, and also I think the important point to note here as well is that bear markets don't equal recessions, and recessions aren't bear markets, right? These are two separate things. Recessions are really about the economy. It's about aggregate income or GDP, things like that. Bear markets just totally about financial markets, right? What the S&P 500 is doing, what investors feel, what valuations are like. And yeah, back to you, man. I know I interrupted you.
No. So, but that's exactly right. Yes, yeah, sometimes they align, but sometimes, you know, they're not the same. If we look about kind of what's priced in at the moment, you know, where we are at the moment, and so, well, the biggest drawdown for the S&P this time around was just over 23%, essentially during the first half of this year. But as everybody knows, it's recovered. It's been a bit weaker this week, but it's been recovered a fair bit. And so now, if you look at it now, we're down compared to the peak. We're down just under 14%. And so that would put us kind of right around the half of this kind of average bear market, if you say an average bear market is 30%. So we're sitting right in the middle of kind of bear market territory. And I think that's a fair reflection of the kind of degree of uncertainty that's out there at the moment.
And yeah, so I like this list. It gives us a bit of, like, again, parameters as to what we can not look forward to, but it gives us a bit of some kind of range here. Right now, there are obviously possibilities or on edges of the range of outcomes here where it could be an anomaly here, right? Because no one would have told you that a bear market would last 1.1 months 3 years ago, right? Now that's a thing. The V-shaped recovery was very strong during that time. But let's look ahead, Matt, because I know we've got some other data points to talk about. I mean, there's only so much we can talk about a recession. Another great point you made, of course, that I think sometimes forget is that GDP numbers are backward looking, right? These are lagging indicators to a large part. So let's look ahead. And I guess from your perspective here, what key factors and data points will you be watching over the next few months that could negatively alter the market's perception of recession risk? Because obviously it's priced in certain amount, but what could trigger, a further decline or something like that?
Yeah, absolutely. Yeah. So what would move the market? And so I mentioned, things like the US job market, consumer spending, things like that. But to be a bit more specific, there's two things I think that we should keep our eyes on. And one is US corporate earnings. And this is, it's an obvious point, but when you invest, you don't invest in GDP, you invest in companies. And obviously companies are affected by the state of the overall economy, but they don't move in lockstep. Earnings can deviate from GDP growth. And the fact is that, US companies have still got really quite robust earnings. And so for 2022, the earnings is expected to grow by about 9.5% for the S&P. And then maybe next year, slightly lower, 9.3%. It's still pretty good. And so right now, US corporate earnings are still very robust. US companies have been very skillful, I think, at passing on inflation to underlying customers. But any sign that US corporate earnings growth is slowing or is going to fall down to levels close to zero, I think that would be a big trigger for another leg down in the market. The companies are kind of trimming their earnings forecasts for next year slightly, but there's certainly no sign right now of a kind of earnings falling off a cliff or anything like that. So this is one area that I definitely keep my eyes on.
Yeah, I think what we noticed is a lot of earnings were actually quite good. I mean, Apple sold really good earnings. Everyone was their current earnings were looking good, but outlooks were, everyone was kind of trying to set realistic expectations. They've come to a point where their outlooks are really, really quite on point. So I think a lot of us are hoping that they're kitchen sinking a lot of this to make sure that, that they are pricing in or giving us certain, because it's all about expectations, right? So if the company says, or corporate America or corporations around the world say that they're looking to earn this, the market will react, kind of rebalance this. And if they beat it, then there'll be an expectation or valuations may adjust to that or prices in any case. So yeah, it'll be interesting to see what Q3 and Q4 look like going ahead. But I know you've got more to watch as well, right?
Yes. So I'm up until now we've focused naturally on the US because that's the place that's been the kind of the core of this kind of inflation shock and then the recession. But obviously we've got to think of other regions as well. As an investor, we're not just invested in the US, we're invested all over the world, and it's important to note that different regions are at different stages in the cycle. And I think the other thing to watch is. Well, I'm not sure if contagion is the right word, but this sign that other major economic regions in the world also tilting towards recession, that would be another big red flag. Where we are at the moment is, if you look at Europe, for example, they've had small positive GDP growth both in Q1 and Q2. But obviously there's concerns about the latter half of the year, especially given kind of the impact of what's going on in Ukraine and energy prices and things like that. The UK is expected to fall into a recession later in this year. Q2 was negative. And then we think of China. China did have a negative Q-on-Q GDP print for Q2. Obviously, China is a very different stage in its cycle, I think, than the US. And certainly the Chinese government, I think, is in a much more strong position in terms of supporting the economy, providing stimulus to the economy. But there's a lot of uncertainty in terms of, obviously, in terms of lockdowns and COVID-related slowdowns, but also concerns, for example, over the state of the property market in China and things like that. The other thing I'd keep my eye on is the major other economic regions. I would say Europe and China. Any signs of those regions slipping towards recession would also be another leg down or another red flag for global markets, I think.
Right. Ladies and gentlemen, if you have any questions whatsoever, please drop them in the Q&A box. We're more than happy to explore other topics as well. So just let us know, put them in the Q&A box. We've got a few questions that have come in, I think about 5, 6, that we'll address at the end. There's one on China as well. Again, we'll get that towards the end of the session. Although we did touch a little bit about China, I think this might require more focused attention towards the end of the session. I think this is basically, I think a lot of providers or a lot of investment houses are starting to look towards China as a place of opportunity. But we've heard this story before, so we'll get into this question at the end of the session. So we've talked about what could tip things over to the negative side, right? Essentially, it's watching how the recovery looks like, not just in the US, but across the globe as well, how different regions are going to process what's going on, particularly on GDP side, their own economies. And speaking of that, let's flip the question around and talk about the upside, right? Because aside actual GDP numbers, what indicators or factors could tell us that we've maybe overpriced recession risk here?
Yeah, sure. I think it's important to keep this thing in perspective, I think. And so these are the most recent forecasts of GDP growth, global GDP growth from the IMF. And it's important to note, nobody's expecting the global economy to shrink this year or next year. So the IMF is expecting the global economy to grow by 3.2% this year, and slightly less, 2.9% next year. And if you look down the list of advanced economies, they're all positive numbers. They're not expecting any major economy to shrink this year or next year. The numbers there are lower than we've seen perhaps in the past, certainly compared to last year. But we are expecting, the global economy to expand. Looking down even further, kind of like emerging markets, China at 3.3%, India 7.4%, obviously lower than we've seen in the past for these economies, but certainly not a disaster by any measure. And the reason why I put that in here is it's very easy to get kind of very pessimistic if you just look at headlines, headline numbers and things like that. But the fact is the underlying global economy continues to grow, and this provides a kind of baseline for corporate earnings growth. And so at some point, the markets will bottom and start to look forward to this year's economic growth next year and the following years. And so the falls that we've seen globally in the first half of this year could reverse relatively quickly once people focus on longer term economic growth, perhaps.
Yeah, it's very easy to get trapped in the short-term numbers, and I guess it doesn't help that when we look at media headlines and all, it's always the biggest numbers, and it's just the way the game has changed, right? As someone who used to be in the media, it's about clicks, it's about someone clicking on your title, clicking on your article. So what's going to get your attention? That inflation is 18%, or that, hey, the global economy is still growing, guys, don't worry, we've got this. Now, obviously, that's an incredible simplification of the situation at hand, but it's something to keep in mind when you take a look at this. It's sometimes we forget about the longer term trends in and amongst the short termism that is so incentivized, I guess, not just in media, but just generally speaking. Matt, I think we've got another point on this question, correct?
This is all I have in here. I mean, I think we were going to talk a little bit about perhaps why has the market reacted so negatively?
Yeah. So
I think that flows on very naturally. I think from here, why has the market fallen so fast this year? The answer is very simple. It's the return of inflation. We've had 40 plus years in the US of falling and then low inflation, and then suddenly we get this spike back up to kind of close to 10%. And it's important to realize that most of the market participants, both in terms of individual investors, but also people at stockbroking firms, asset management, they've never experienced this. This hasn't happened in 40 years, and so I think there's a case of people not knowing what to do. They know in theory, what to do about inflation, but they've never experienced it, and so people are unsure about how to react to this spike in inflation. Then the other point I think to make is, for the 3 years prior to 2022, we tend to forget. We tend to have a very short memory, but we had some very, very strong equity market returns. And so this table down at the bottom right here, this is MSCI global equity index. So you can see, for the 3 years previously, we've had, double-digit high returns. And so it's, in a sense, it's perfectly natural to see an element of reversal in 2022, given the strong returns we've had over, the previous 3 years.
Yeah, and just to highlight to everybody that these kind of double-digit returns are not normal, right? This is not, don't get spoiled by these numbers that we're seeing here. The average market return, let's just take the S&P 500, for example, maybe 10% of the last 40 years annualized. Global markets, on the other hand, maybe around 7-8% annualized, maybe a bit less, because taking into developing and emerging markets as well. These double-digit numbers we've seen, yes, to a big extent, they've been driven by certain particular companies. But yeah, just because this is what I think we refer to as mean reversion, right? Over the longer term, things will average out. And how do they average out? Well, by having negative returns to balance out the equation a bit on the longer term. So this, I guess, I think that a big part of, when you see, again, media narratives about 1,000% returns in Tesla and 1,000% returns in this crypto coin, it's kind of spoiled the market. Not to say not spoiled individuals, but it spoiled the perception of returns, I think, for a lot of people, particularly newer people to the investment industry, where I've actually had someone who asked me, how do I turn 1,000 ringgit? So I used to be a financial planner for a little while, who asked me basically, how do I turn 1,000 ringgit into 5,000 ringgit in 6 months? And the answer is, and this is not advice, guys. The answer is either go gamble or go crypto, right? Like it's basically go and speculate or gamble this money, because there is no way to actually guarantee anyone in 6 months you're going to quintuple your money. But again, because a lot of there's a very, very low level of financial literacy, financial education, people don't know what a realistic annual return is. So I guess there is that kind of perception in the market that these things are possible, which is scary to a certain extent. But hopefully, with more financial education, I know we got a lot of planners in the room as well. I think we're all trying to do our part to help with financial literacy and financial education. But with regards to this particular point, the market reaction being so negative and the last 3 years, Matt, is there anything else to add to this slide?
Yeah, no, I think that this is a good summary. And that shows, I think, why people have reacted so much. This is, in a sense, this is kind of like a classic kind of recession. Inflation spikes up, the central bank reacts, raises interest rates, tries to calm things down, tries to slow the economy. And so in that sense, it's a classic kind of recession. But the fact is, we haven't seen one like this for a long time. And so I think, this is causing quite a lot of confusion amongst investors as to how they should react.
Right. So, Matt, maybe we can spend just a little bit more time on this, the topic of inflation, for those who may not be, because again, inflation hasn't been globally just talked about. Asian countries have faced it. Other emerging markets have faced inflation in their own right. But on a globalized level, to this extent, it's not been such a hot topic. So maybe you could just explain to us why inflation is so scary. Because we do want a certain level of inflation over time. But Why is it that this year suddenly we're seeing this high level and people are getting like jittery and scared about it?
Yeah, sure. Yeah. So you're exactly right. A level of inflation is perfectly healthy. Most central banks don't target zero inflation; they target 2% inflation, and that allows companies a little bit of leeway to pass on cost increases and move prices around. So an element of inflation is a healthy sign. I think what's worried people this time around is perhaps two things. One is the speed with which inflation came. I think you can see just looking at this graph, it went in the US, essentially from 0 up to nearly 10% within a very short space of time. So the speed was one thing that worried people. And then the other thing, obviously, is the underlying cause of inflation here. There's various different causes of inflation, too much demand, supply shocks, things like that. And certainly the initial cause of inflation in the US and in other countries as well was to do with energy prices. The spike in energy prices, obviously driven by events in Ukraine, that knocked especially the global oil market out of balance. The oil market was already very sensitive as a result of supply shocks, supply constraints following COVID. But then taking out a whole bunch of supply from Russia put the global oil market way out of balance and spiked it there. But then the worry that people have seen is that it's not just energy prices that have been rising, it's food, a lot of very basic commodity prices have been rising as well. And then when you get to that kind of situation, it becomes much more difficult to lower inflation expectations going forward. And so I think it's this combination of the speed with which inflation rose, and then the fact that it's spread beyond simply just the energy sector to a range of different products throughout the economy that's got, I think, people worried.
I guess the part of that is when we look at our returns, right? If our money is growing at, let's say, 7%, but inflation is growing at 10%, then on a real basis, we've actually got like -3% returns. So I guess that's also part of the equation. People are concerned that the value of their money is just shrinking in front of their eyes. And will they be able to purchase the same kind of goods? People stop spending, economy shrinks, and the cycle just keeps going. If it's not managed, I guess, appropriately. But moving on from that other, of course, to round off this conversation about the recession side of things, I guess a question on a lot of people's minds here, still got about 60 people in the room with us, is what kind of strategy could be employed when it comes to investing during a recession, right? How does it differ from regular investing, regular times?
Yeah, sure. And so one very popular way of investing through the cycle is this idea of kind of asset rotation. And this is this idea that, at different stages in the economic cycle, different assets perform well or badly. And so this table on here shows, the economy in various different stages, 4 different stages: recovery, expansion, slowdown, and recession, and the performance of different asset classes: equity, government bonds, HY is high yield bonds, IG is investment grade, so corporate bonds. And you can see, equities do well in the first 2 stages of economic growth, but they do badly in the slowdown and the recession, whereas perhaps bonds the other way around. And so it's a very tempting approach to think, well, I could rotate my portfolio so that I'm always in the right asset class for the stage of the economy that we're in. And I think a lot of managers claim to do this. And this is it's a valid approach, but what I would say is this is an extremely difficult thing to do consistently. I mentioned earlier that you don't know at the start of a recession that you're in a recession.
Yeah.
You know after the fact, whereas asset prices move much more quickly than that. And so you need to have a very good sense of where the economy is before any of this public data comes out in order to do this effectively. So the manager needs to be extremely skilled at doing this. And then the point is, the risks of misjudging this, even just by, 1 or 2 months, getting the timing wrong, can be extremely painful. You could be in the wrong asset class for just 1 or 2 months, and that could really negatively impact your returns. So while I know there are certain managers out there that claim to have models that can guide you through this kind of asset rotation, in my experience, these are extremely difficult to do consistently. Other approaches are more to do with kind of like trying to manage risk through the cycle. That's perhaps a little more realistic, perhaps, rather than trying to forecast returns. Manage the risks. Certainly the risks of different asset classes move through the cycle. Perhaps that's easier to do. Or there's other approaches where you simply say, this is my asset allocation, I'm not going to change it, and simply mechanically rebalance all the way through. There's different approaches. They have kind of pluses and minuses to them. But I would personally say that this kind of aggressive kind of asset rotation approach, while it looks nice on paper, and it can sound nice, and everybody will have a nice back test showing how these things always work. But my experience is certainly from a kind of a forward-looking basis is these are extremely difficult to make money from.
Yeah, so maybe we could just dive into that a little deeper, right? So market timing is essentially one of the points that we're highlighting here. Oftentimes touted as essentially a losing game for most investors, right? Maybe not if you maybe have the most amount of, if you're highly in tune with the information on a high level, you've got satellites watching factories, which is something that people do, and all those other things there. Yeah, so market timing generally touted as a losing game for most investors over the long term, particularly for retail investors. But if we know that recessions and market crashes happen every so often, shouldn't we or why don't we just wait for those crashes to happen and then buy the dip and then, time the market that way?
Yeah, sure. Yeah, I think that's a very fair point. I mean, this is a diagram I've used several times before. I really like this. This shows bull and bear markets, again in the US, but the global picture is very similar to this, going way back, essentially to just after the war. Obviously, the green parts are the bull markets, the red parts are the bear markets. And there's a couple of things to point out on here. One is in terms of the amount of time. They're far more longer bull markets than bear markets. The bear markets tend to be relatively short. They can be very painful, but they're, in terms of the amount of time and the size of the returns, they're much smaller than the bull markets. The other point to make is this point about mistiming. And even if you just miss the last few weeks or the last month of these bull markets, if you switch into a kind of a bear market mode just a little bit too early, or you're a little bit too late in switching back into the market at the start of the bull market, you can lose a big chunk of the returns. And this is what I mean about the kind of the potential cost of market timing. You only need to be, especially in the equity markets, you only need to be out of work for a few days or a couple of weeks, and you will lose a large chunk of your returns. And so, unless you're very skillful in terms of being able to predict these bear markets, market timing, trying to jump in and out of the market is an extremely risky thing.
Matt, thank you for sharing this particular slide. I think this is from another report, but it's a great visualization of also just how, in hindsight, bear markets really aren't in perspective as damaging as the upside that we get from equity markets over the longer term. But also just the duration. I mean, look at those red specks. They're red specks right now on the chart. Right now, it feels like the end of the world to a lot of people in the market. But when you look at it in hindsight, it brings a bit of, again, from a long-term perspective, brings some perspective here. But of course, for those who are maybe fully invested, when they hit at the top of the market, it can really be a very painful endeavor for them. This reminds me as well, like, equity markets, some of them come and go, right, geographically. I mean, the Japanese equity markets were hot in the late 80s up till the I think the end of the 80s or at the start of the 90s. And, the Nikkei 225 peaked. And I think till today, I think it bottomed somewhere in 2008, but still hasn't fully recovered. So if you were fully invested in the Nikkei 225 at that point, you still wouldn't have recovered, which brings me to my next question. One of my favorite concepts in all of personal finance and investing, dollar cost averaging, right? And asset allocation, right? So dollar cost averaging and asset allocation is basically a way to diversify risk over time and over assets, two particular things. DCA is pretty straightforward, right? You invest a consistent amount of money on a consistent basis into quality assets, quality, well-diversified assets. And the reason I say the last part here is because not all dollar cost averaging is created equal. The common mistake I've seen a lot of people make is basically dollar cost averaging into a single stock or into a single concentrated thematic ETF or unit trust funds, essentially with that belief that they're investing the next big thing. So Matt, maybe you could break down for us why diversification via asset allocation is vital for dollar cost averaging and long-term set it and forget it investing, and maybe even break down a little bit of DCA.
Yeah, sure. Yeah. Maybe let's just mention DCA before we get into the diversification. But you're exactly right. Yeah, this is the idea of kind of diversification across time, not putting all of your money in at the same time. And you often see kind of these kind of diagrams where they're talking about dollar cost averaging, comparing somebody who put all their money in on day one with somebody who put in like a regular amount in month by month. And, in that case, the person who's making these regular payments can essentially take advantage of falls in the market. If they're still putting in the same amount of money, then if the market falls, they're going to be buying more stock with that same amount of cash. And so assuming that the price eventually recovers, then dollar cost averaging can be a nice kind of boost to your return. There are people who argue against dollar cost averaging and say, if you expect the market to go up in the long run, then you want to put all your money in as fast as you can. And there is an element of truth to this. But just like you, I'm a huge fan of dollar cost averaging. For a slightly different reason. The reason why I think it's a great thing is because it gets people into the habit of investing.
Yes, behavioral, right? It's a behavioral hack essentially.
Exactly. Yes. So you make some kind of decision that you're going to put away, $100, $200, whatever, every month, and if you can, you set up some kind of automatic deposit from your bank account, so you don't have to do anything, and then that happens every month. It gets you into the habit of investing. And it gets you away from these kind of behavioral biases where you think, oh, I don't like the look of the market right now. Maybe I should wait a couple of weeks. Those kind of biases don't help you at all. That, in my opinion, is kind of the real value of dollar cost averaging. It gets you into the habit of investing and investing regularly.
Yeah, because I've read certain reports as well as in terms of the efficiency. Dollar cost averaging may not be the most efficient in terms of providing returns of the longer term, because, like you said, Matt, if you believe that the market's going to go up, why not put all your money in now and invest? Even if the market goes down over the longer term, it's going to go up, etc., etc. I have a book recommendation here from Nick Majuli, who's a blogger, data scientist, who wrote "Just Keep Buying." Highly recommend everyone take a read of that book. He explores this idea, but from a behavioral perspective, getting someone to put, if there is a certain level of risk in the sense that what if they do it wrongly, right? It's like they say they got a big sum of money, they put it all in one shot, and they invested in Nikkei 225 in 1919. That's why we want asset allocation across the globe, so you're not concentrating in one particular geography as well. But yeah, it's a great behavioral tool, because a lot of times you are not going to be able to trust yourself or the willpower, the discipline to do it all manually on yourself. So it's not the most it's not going to maximize your returns, but it's going to get you involved in the market over the longer term and involved in the upward sloping trend. Back to you, Matt.
Sure. I'm just a little conscious of time. Just
yes.
Briefly, if we just briefly mention the value of diversification and kind of the key part of this. I mean, I think everybody is aware that this is an idea of like kind of spreading your assets around to essentially to control the risk of your portfolio, and taking advantage of the fact that not all assets move together at the same time. The only comment I would make on diversification is you sometimes see comments about people negatively commenting on diversification, say a word like diversification, this idea that you can be too diversified. And I think this point has an element of validity in it, but I think this is coming from a misunderstanding. The point of diversification is not to spread your assets as widely as possible. That's not the point. The point is you should have an objective for your portfolio. You should have something that you're aiming to achieve with your portfolio. A certain, for example, a certain return target or a certain return profile. Then you want to build the portfolio that's going to get you that objective with the least amount of risk. That will naturally lead you to the right level of diversification. You have to be able to meet your objective first. Diversification comes after that. You're trying to build a portfolio that meets this objective with the lowest possible risk. You're not trying to build the portfolio that has the least possible risk. And I think that's where people get confused about diversification. You have to meet the objective of your portfolio first. And then within that, try and build a portfolio that does that with the least amount of volatility. That would be my point on diversification.
All right, Matt, I think that rounds off our particular set of questions, right?
Yes. Maybe we should.
Yes, let's get
to the Q&A. Yes.
Yeah. So first and foremost, I'd like to apologize to everyone for keeping you so late. We can get into that the other slides another time, essentially. But for now, let's get into the Q&A. Yeah, there we go. The Q&A. One of the questions I want to bring up, all of them an anonymous attendee. So the first one is, what's your view on the China market? Will it recover anytime soon? Is it investable at this point? And I guess this brings up a larger question around, we're starting to see a lot of people pointing to Chinese equity markets as a point of opportunity, right? I've seen many research reports come out saying this. What are your thoughts on that? Because the Mytheo portfolio on its own, the growth portfolio, doesn't have a whole lot allocated towards China and Greater China. So overall, what are your considerations and your thoughts?
No problem. Yeah. So in terms of how we invest in China, China is part of our investment portfolio, as you said, in the growth portfolio. And so obviously we have China exposure through Chinese companies listed in the US. We also have Chinese companies listed in Hong Kong as well. We don't have kind of specialized Chinese sector ETFs, things like that. Our exposure to China is broad-based, but it is part of our investment portfolio, and we don't have any kind of particular constraints or anything on it like that. In terms of the attractiveness of China, I think a lot of the comments that one sees are the fact that China is at a different point in the economic cycle, and therefore it should be diversifying to other equity markets. But also the more obvious point is, China is cheap right now. The valuations of Chinese stocks, certainly when you compare them, especially to the US, are cheap. And so from that kind of point of view, you could argue that the kind of risk-reward ratio is quite attractive for Chinese stocks. I don't have a particular view on the Chinese market. I'm not an expert in terms of the Chinese market itself. I would say that, there's been plenty of disappointments, I think, with the Chinese market. People calling for higher allocations to the Chinese market and then facing quite a lot of volatility. So I think it is naturally still a volatile market, and you have to take that into account. But certainly we have exposure to China and will continue to have exposure to China within our growth portfolio.
Other question we have here is, what's your view on the Buffett indicator? So I'm not sure whether you have a view on the Buffett indicator, Matt. It's essentially I think Warren Buffett likes to use a correlation, not a correlation. He likes to divide GDP by the stock market valuations to kind of see whether it's overvalued or undervalued. Do you have any thoughts on this?
Yes. Yeah. I mean, you
ratio. That's the word. The ratio of the GDP to stock market value. Right?
Yes. Yeah. That's a good point. So you have to be a little careful. You can't. Warren Buffett has a track record that speaks for itself. So you can't really go against that. And these kind of ratios, you see them in different formats. And they're essentially a ratio between kind of, fundamentals and valuations, and the underlying argument here is that valuations can't get too far away from underlying fundamentals. And I think there's an element of truth in that. However, these kind of ratios are terrible at timing anything to do with markets. And so, they're useful indicators in terms of where kind of relative risks might be, but they're not going to help you make an investment decision today, is my experience. And then the other point is, especially when you're talking about kind of US, it's very easy to forget the kind of structural changes that have gone on in the US stock market over the last 20, 30 years. Right now, depending on the sector, but 30, in some cases, 40% of the revenue comes from outside of the US. And so dividing the value of the US stock market against US GDP misses all of that external revenue. And so it can make the US market look very expensive on that kind of measure. But it's simply a fact that US companies have become much more global than they've been in the past. And so I certainly wouldn't disparage anything that Warren Buffett uses. I mean, he's, but I would say, you've got to use those kind of things with caution and understand, what they're really getting at, rather than simply focusing on a single number or anything like that.
Yeah, I think a point to highlight there is, of course, that Warren Buffett or Berkshire Hathaway as a whole have a very long-term horizon, right? So a great point you made is that the Buffett indicator is not going to tell you to buy now. It just gives you a sense of valuation, a general feeling of valuation, because there are also going to be other things to take into consideration before. And any individual makes their own investment decision or builds their own investment process. Speaking of ratios, we have another question about the CAPE ratio or the CAPE PE ratio. I think this is the cyclically adjusted PE ratio, if I've got that right.
Yes.
Basically asking what's your view on that, if any.
Yes. So this is perhaps a little more useful ratio, perhaps, than the Warren Buffett one. And so this is looking at valuation of the stock market compared to some kind of smooth measure of earnings. And so this is cyclically adjusted earnings. And that does show the US market relatively expensive, not absurdly expensive, but relatively expensive. And this kind of measure is, it tends to, again, not to be useful in terms of kind of market timing. It's not going to tell you when the market is going to crash, but it can be good for controlling expectations of future returns over, say, like the next 10 years. And so that kind of CAPE ratio does have some value in expectations of, say, US equity returns over, say, like the next 10 years or the next 15 years, that kind of thing. And I think, what's that's telling us is that, it's telling us the obvious thing. We've had 10 plus years of very strong equity returns in the US in particular, global returns as well, but especially in the US. More recently, really quite concentrated returns in certain sectors. And we shouldn't expect those kind of returns to carry on forever. We saw earlier on in that slide where global equity returns over the last 3 years have been way above average. And we shouldn't get carried away and expect 15%, 20% returns every year. That simply is very, very unlikely. But a long run expected return of 7-8% for global equities is perfectly normal and perfectly adequate to build a very good portfolio over the longer term.
I think just to round off the conversation, there's a related question here, and then I think we can wrap up after that, unless there are any new questions come into the box in the next 2 minutes. So you mentioned that concentrated upside, right? So even with the correction that tech stocks or US tech stocks have seen this year, they still have represented a huge upside for the market overall, really just even during the pandemic, dragging the US stock market along, the S&P 500 returns and things like that. How has Mytheo positioned itself to take advantage of these long-term potentials shown by tech stocks? Has it done so?
Yeah, sure. Yeah, and maybe just to explain a little bit about how we approach, in particular, the US market. The US market is so large and so diverse that you don't really want to just have one ETF in the US market. And so for the US, we split it into 2 dimensions, one based on market cap and one based on kind of growth versus value stocks. And so we actually have a total of 6 different ETFs, large cap, mid cap, small cap. And then for each of those 3 market caps, value and growth. And that gives us, the combination of all of those 6 gives us complete exposure to the US market. So all of those are in our investment universe, and we have positions in all of those. If you look, for example, right now, we're roughly evenly balanced in terms of large cap value versus large cap growth. And so this is telling us that, from our model's point of view, we think there are roughly equal opportunities between large cap growth stocks, and naturally a lot of the tech stocks sit in that bucket, and large cap value stocks, which tend to be kind of perhaps more defensive, more stable stocks. And so our position right now within the Mytheo growth portfolio is essentially equally balanced between those kind of tech high growth stocks and more traditional, more defensive value stocks.
Right. And just to be clear as well, in terms of there is no maybe like, a lot of other fund managers or provider or platforms may go overweight on US tech or something like that. That's not a typical approach that Mytheo does, right?
That's right. Yes, the model is able to go overweight to certain sectors, but those overweights tend to be relatively small. I think it's important to bear in mind that the tech sector is a risky sector. If you look at kind of realized risk, perhaps over the last 3 or 4 years, it looks relatively low risk. But if you look at over a longer horizon, any growth stock has a larger amount of risk to it. And so it's important to take that into account, I think, in the portfolio construction. We certainly have exposure to those kind of sectors, but they're not a dominant part of the portfolio.
Last one here. We have one more question from the audience, from an anonymous attendee. It's a bit of a question and a statement at the same time. So could this aggressive inflation be due to the change in unprecedented human behavior after a pandemic, which triggered revenge spending? Basically, in quotes here, I better spend before another pandemic hits. I think this is a behavioral thing, right? I think some of us have noticed that people are spending more post-pandemic. That's why we're seeing consumer spending, right? particular one data point here that's been very interesting to notice. People are out and about, people are spending money, even though we are in a technical recession. I mean, the US is in a technical recession, but global economies are getting a bit concerned. Any thoughts on this, Matt?
I think that's a very nice point. Yeah, I think that's a very good point. And I think that it's very plausible, isn't it, that there's an element of that. People essentially have been kind of tying up their demand, not able to spend in many cases for 2+ years. When we've seen it, seen it in terms of kind of like overseas travel, vacations, stuff like that. People who have been essentially stuck, unable to go overseas for 2 years or so, and even though it's not complete, but the people now have a wider range of places that they can go to, and we've seen like a huge burst of overseas travel, people going to Europe, people going to other parts of Asia, things like that, any country that opens up to tourism. And so I think that's a perfectly valid element of inflation, this kind of pent-up consumer demand. I think you'd expect that to be a temporary phenomenon. I mean, the idea that a bunch of demand has been pent up and needs to get out of the system. I think so that kind of push is likely to be temporary, but obviously the danger is that leads into longer run inflation expectations that are harder to get rid of.
All right. On that note, Matt, I think we can wrap up today's session. To the 42 people still with us, 15 minutes past our supposed time of end. My apologies and my deep thanks for being here till the very end with us. I really appreciate your time. If you have any feedback, any comments whatsoever, you can get in touch with us on Instagram or Facebook. We also, if you can go to mytheo.my to also send us feedback, emails, and messages there as well if there have any points. To everyone who's been here, thank you so much for your time. We really appreciate it. Matthew, also always a pleasure speaking with you for the second time that we've spoken for a session, but always a pleasure. Thank you so much for your time.
Thank you.
Ladies and gentlemen, that was Mytheo Stuart-Box, the Chief Investment Officer of Mytheo. My name is Roshan Karnasan. I'm the Head of Content and Strategic Partnerships here at GEXMD, the home of Mytheo, and you've been listening to, you've been watching Mytheo Live. Thank you all and have a great night ahead. Bye.
Let's take a moment to talk about money. We all know how important it is to save. But no matter how hard we work to build our nest egg, experts believe most of us still won't have enough to retire comfortably. Investing is the better way to grow your wealth, but requires years to master on your own, or high fees and starting capital to hire a wealth manager. Now, there's an easier way for you to invest. Mytheo is a digital investment manager that does the work for you using investment strategies with a proven track record, helping over 60,000 Japanese investors grow their wealth. That's over $300 million of assets under management. And this is all it takes to start investing meaningfully. When you create an account, Mytheo will want to know you a little better. Things like your age, assets, and appetite for risk. Once it has collected enough information, a professional investment portfolio will be generated just for you. This portfolio will consist of ETFs listed in the US stock market. Each ETF is selected for its different feature, such as country or asset class, to further diversify your portfolio, and that disperses some of the risk. This global diversification strategy is one way Mytheo optimizes your portfolio. The algorithm that drives Mytheo's logical investment reasoning is based on the research behind 2 Nobel Prizes. In the past, you or your fund manager would have to closely monitor the market's various moving parts every day. That's a lot of data and decision making. With Mytheo, you don't have to sweat the hard stuff. It automatically rebalances your portfolio to its prime investment position. What Mytheo does for your portfolio is no secret. View the rebalancing data anytime from your account, accessible via the app or website. You might even want to start calling the shots one day. Go ahead and adjust the portfolio to suit your needs. After all the money talk, here comes the money talk. Thankfully, Mytheo's service will not break the bank, just a small fraction of your investment. With no sales fee, no exchange commission, and not a single surprise charge. So the question to ask yourself is this: will it be worth it? Deciding to invest may mean new commitments and lifestyle adjustments. It could also mean the freedom to do what you've always wanted, not just life's milestones like marriage, kids, and retirement, but the moments in between that make life richer. Whatever it looks like, it's time to invest in experiences that truly matter to you, because life's moments are priceless.